YouTubers are lying to you about the upcoming housing market crash, and they're doing it just to get clicks and views on their videos.
I know. We watch these things all day long. People sending us stuff all day long. That's why it's confusing online, right?
Yeah, absolutely. And I think that, working with home buyers and things, everyone's just waiting for this huge housing market crash in order to buy. And I just feel like if you sit on the sidelines, you might miss out on a good time to buy, because it actually is right now a buyer's market. So it's actually a decent time to buy. If you're an investor, it's a hard time to buy with cash flow. But if you're a first-time home buyer, I mean, you're getting seller concessions. You're able to negotiate the price. Days on market are up. All the things, right? But people are just waiting for it to get like way worse.
Yeah. Here's the thing, guys. You got to stick with math. Like as you guys always know, I always say, just look at the math. Like when you're buying a deal, it's all about the math. Expenses minus income, which is the NOI, and then your debt, and then does it cash flow or not? And so it's the same thing here. Like what's the inventory levels? What are the inventory levels? That's a huge thing. What's going on days on market? Another huge thing. What's happening with the delinquencies, which we're going to talk about, and what's happening with the how quickly things are being sold, the interest rates, and all that stuff. It's all just data, and so you got to be careful not to get rush in this particular time.
Yeah, and Jerry, if you can pull up clip 1 for us. Are we just not going to see it on our end? Okay. So this is, reventure, and see, you have a lot of views on these videos, right? And he talks a lot about crashes that may or may not ever happen. 27% loss, 35% drop in this market. We're just not seeing that. So you guys have to be careful the videos you're watching, and what, if is it clickbait? Are they, because, these videos get a lot of views, right?
So Danille actually went and looked and actually tried to track all the data.
Yeah, exactly.
Like these are videos that she watched, and then she went and started digging into the data itself.
Exactly. And I think that that's what is important. Now, to be clear, we're talking about the single family market right now. In multifamily, we have seen major corrections.
Right. Now that's different, but that's because the interest rates went up and the cap rates went up. Mm-hmm. So believe it or not, the operations haven't changed all that much.
Right.
So the net operating incomes of most of those assets are not that much different.
But I had to throw that out there because we're going to say this, and then people are going to get on us about the multifamily market. So right now we're talking about the single family market.
Yeah. Single family is more like a commodity, right? Like if you have a lot of listings and days on the market is high, then you're going to start to see prices kind of gradually go down. Whereas multifamily, commercial office, retail, that's based on very different metrics. It's obviously if there's a lot of them for sale, it's going to be harder to sell. But what they really are based on is how much rent do you have coming in, what are your expenses, and what's the mortgage payment, and what's your cash flow.
Yeah. So let's take a look at this first Fred chart. So the first thing that you would think if you were going to have a housing market crash and people were going to be fire selling their houses, one of the first things you would look for is how many people are delinquent on their mortgages. Because Correct. In 2008, we had high going into 2008, you started to see higher delinquency rates, right? So if you look now in 2024,
they're down.
They're down from
a lot.
Yeah, they're down from even 2019. That's kind of where we're at right now. Is that same 2019, 2018 kind of margin.
Right. And in 2019 and 2018, you guys hopefully remember, like, the market was not bad.
Right.
It was, I guess, normalized, right?
Right.
It jumped, of course. You're going to see the spike there during the pandemic and all that, and it's kind of you pretty much have to just discount that, but now you can see it's settled back down.
Exactly. And so that's one of the number one things we look for when we're looking for, is the market going to crash? Is there a correction? Is there something stirring that nobody's talking about, kind of thing?
And I want to point out, like, what's really happening is that people are not used to these because it hasn't been this way in the last couple of years. But if you look at historical numbers, that, days on market are supposed to be 4 to 6 months, right? Mm-hmm. So the inventory levels are really, really, really low, and days on market is not at 4 to 6 months in most markets, right? Now you are seeing a smattering of like in some areas of Florida, where on the Airbnb and stuff like that. We need to mention those. Obviously, you're going to see those hit the market, but especially now, you start to look at the lack of new construction that's coming. You start to look at things like the fires that we just had in California and the people that all had to relocate, all those folks. They're hitting right now in Phoenix. They're hitting in Vegas. So, we're seeing them hitting up and down the coast. And so what that's doing is it's adding new people to those markets. And, of course, you're going to start to see, some of those days on market even get less and less.
Yeah, and I think Red Baron said it. He said, if you keep saying the market is falling for 10 years, you might be right once or twice. But it's more for entertainment, not for knowledge. And that's what we're trying to get through to you today. And a lot of you are commenting that buyers can't afford to buy. And I'm going to argue with that point because I work with buyers and I know a lot of them, they're waiting for prices to correct. They know what they can afford, but they don't want to have to pay a higher price than they have to. And I think that a lot of people are on those sidelines right now.
But they do have a point. I mean, if you take a look at I think it's 2024 statistics, there was a very small percentage of realtors that actually sold houses compared to the prior years.
Yeah.
Right? I think it was down like 71%. So you think about that. That is a direct result of that comment. Somebody said, the mortgage prices are up a lot, and so people are looking at affordability problems. I think what we're trying to say is that doesn't necessarily mean just because you have a high mortgage doesn't mean that the home price is going to drop. Right. And that's, I think people are trying to tie the two together. Home prices drop when there's a lot of homes. When there's a excess inventory homes or people leave an area, that's when they drop. Or of course, if the rates are really, really low. And so none of that's happening right now.
Yeah, people don't need to fire sale their properties because even if they have a property and it has a low mortgage or a low interest rate on it, they can rent it. And we've seen a lot of that, like sellers pulling off their houses off the market and deciding to rent it instead of sell it and just wait if they can't get the price that they want. And so there's just not a lot of urgency with sellers right now. And there's hesitancy with buyers. But, my fear is that people wait for this crash that's, people were waiting for a crash in 2019 and look what happened there because of 2020. People are always waiting for the next 2008. And when you do that, you kind of miss out on opportunities.
Well, one of the things though, Danille and I were talking, is that she has a single family home that is rented all the time. Mm-hmm. And the rents are as high in that property as could be. And then she has a condo where she's starting to see higher HOA dues, and they're starting to see more listings, both on the rental side and on the sales side, because it's a condominium project. And there's 300 of them in there. So as you start to see a lot of inventory, there's more competition for her. And so what's happening is her rents are kind of getting driven down a little bit. So we had this whole conversation about, well, maybe you should 1031 from that into a home, right? Into an area that has a lot less renters, right? So that's something that she's considering right now. And so we were just doing the math. And I said, well, you're going to get over $1,000 more a month in rent just by taking this lateral move. And now it's going to cost more. The house is going to cost a little bit more. But the incremental cost of that house with $1,000 more a month makes complete sense.
Absolutely. So let's start talking about, the economic factors of, a housing market crash, right?
Yeah.
Because I think that this is important. So let's just assume everybody's right. For those of you listening that are just assuming there's going to be a crash, you have to have data for this. So let's just kind of go over. So you need economic factors, right? So
Correct.
You need a recession, right? A recession
which we're not in.
could trigger a housing market crash. Now, when you look at our economy now, what is Trump doing? He's going to bring jobs back to the U.S. He's going to bring a lot of jobs back. That's why he's doing everything with the tariffs. That's why, this is his whole plan, right? Is to bring jobs to the U.S. So you're really most likely not going to see a long-term recession because he is a growth-minded leader of a country, right?
And he's a real estate guy. So, historically, he's had he's already talking about pushing lower interest rates. I mean, what's going to help the housing market is more supply, the ability to build, private-public partnerships. Those are the things that are going to help the consumer.
Right. So, but if you're looking specifically at a recession, Jerry, can you pull clip 4? So here that, you're seeing the headlines and they kind of interviewed a lot of businesses. Employers are budgeting for a 3.5% pay raises in 2025. That's that's typical. That's what's still continuing to happen. Those aren't lowering salaries either, because that's the other thing that can happen is if salaries start to lower, but we're just not seeing that.
No. And I do want to point out that 3.5% could be even less than inflation. So one of the things that could happen with this new administration is we might see some inflation, temporary.
Well,
inflation.
so that's the second thing we're going to get to. So overinflated prices on homes is another thing that can cause, a crash, right?
It could.
And that's kind of what happened in 2008. Home prices got kind of too expensive and your incomes didn't catch up with the rising home prices. But Jerry, if you can pull clip 6 for us. And if you could switch it to the 5-year.
Yeah, this is an interesting one. These are inventory levels, right? Mm-hmm. So this is a really important one, I think, that you guys should pay attention to. And these inventory levels are, if you take a look, they're low, right?
Right.
So, as you start to factor in what happened in 2008, because I went through this, is the inventory level shot through the roof. We had years of inventory levels. Mm-hmm. And so because as the banks were licking their wounds and the people were losing their places, they were also defaulting into the rental market. And I think that's an important piece. What happens at this point? Let's look at the other side of the equation. The other side of the equation of not being able to buy a home is it's going to fix the rental market, because right now the rental market's a little bit soft. It's soft because of the new construction. So you would think that the renter is actually having a time of it right now because they get more choices. There's this new construction that's hitting the market right now in most of these big metros. It started 2 and 3 years ago. And so because home prices are high and mortgage payments are high, it's keeping more people in the rental market. And we've talked in nauseam about this.
Right. I mean, these people have to go somewhere, right? So, those that are saying people can't afford to buy and that's why home prices have to come down. Well, if more people can't afford to buy, then rental prices the demand on rentals will actually go up. And if people are going to rent these houses out, right. I mean, it all comes back to a supply and demand issue. It can either be landlords buying them for rentals or people buying them to live in, but people need housing and we only have so much. But you do have to look, I think that people are seeing a big decline in home prices on listings, right? They're seeing, $10,000 cuts here, $20,000 cuts there, and they're really fixated on the fact that the housing market is dropping, right?
Yeah.
But
those are not big decreases.
But not even that. So I was looking at, my condo, I'm looking at listing it, right? And in my complex, these condos haven't sold in 6 months. They're listed at right around $360,000 to $387,000, okay? And I pooled the ones that sold a year ago sold for $330,000, $340,000. Okay.
That's my point.
Nobody sold for $387,000. So the real number is right around $330,000, $340,000. These sellers are just overpricing the properties. No property is sold for that. So if you would see a condo in my building listed for $387,000 and you would see a $30,000 or $40,000 price drop, you would say, prices are dropping. This is crazy. The market's going down by 20%, but it's not. They never sold for $387,000. They were selling for $340,000. people just decided they wanted to list them for 404, 387, 365, and now they're sitting. So you have to be careful when you see price drops. You have to base them on what's actually sold, not what's listed. People can list a property for whatever they want. It's what it actually sells for that is your comparison.
Right. That's a really good point. You, as you guys all know, first of all, most of you are astute real estate investors. You're almost never going to offer the price that's for sale at anyway. Right. So that's number one. So just because the listing dropped, the pricing doesn't mean that the housing market's dropped. And so Danille's right. You got to go back and take a look at 2023 data. Also, you got to kind of mirror it with interest rates. So, because what was going on with interest rates at that time? So if prices are going up at the same time interest rates are going up, then it's to that one person's point. It's harder and harder for them to have that exact same home. And so in theory, what should happen and what's happened in the multifamily market is as interest rates went up, the values went down.
Right.
So that's different. The values went down because I'm solving a cash flow. But in this particular case, if somebody's mortgage payment goes from, three grand, let's say, to $3,500, that's significant. And then if you add if you bump the price of the home, it's going to make it even worse. And so what's happening is the market's kind of settling. But I would not say prices are down. I would say they're flat.
Right.
And people have in most cases, they've listed them for too high. We're seeing that all over the place. Now, there are exceptions. We know this. We've looked at some submarkets in Florida, for example, where, you have in neighborhoods just a flood of listings. Obviously, whenever you have that particular neighborhood is going to get repriced for sure, right?
Right. This is all local. So in your area, you might have more listings, but we're just saying nationwide, the amount of listings are up, but it's not significant. It's like back to the 2019 levels. It's nothing that's crazy. Right.
So just be careful as you guys are, starting to figure this out. The other thing is I, like a lot of you, believe that we're going to see some mild interest rate cuts over this year. Like we're talking about a quarter point here, quarter point there through the year. That is not going to change much. I mean, it's going to change a few things. It'll help people maybe afford a car. People will do all kinds of stuff with that. Even potentially help them a little bit. But at the end of the day, what really moves the needle is the price of the home.
Well, and even so, I was looking at 2019, and the average day on market for real estate in 2019 was 54 days. Now it's 61. So we're basically down back to normal levels, right? Because people are so used to things selling in a day, a week, 2 weeks, that they just think that this is, a long time for something to sit a couple months. But that's really kind of normal.
Now, prices were higher, though, now, today, than they were in 2019, right?
Yep, absolutely. But I'm just saying, as far as the market moving, things are moving. So something else that creates a crash is people walking away from their homes, right? Like in 2008, and this is important to listen to because in 2008, you had 0% down mortgages. And a lot of people had those subprime adjustable rate. Right. So if you don't have any money in something, it's super easy, minus your credit, to just give the bank back the keys, right? Like, I didn't really buy this for anything. I just had my mortgage payments, which similar to rent payments, and then I'm going to leave. Now, most people have at least 10, if not 20% down into their mortgages. So if you walk away, you're walking away from a big chunk of money too.
And not just that though, but also they also had a run up in pricing, right? So they have built-in equity that the market gave them, by the way. So aside from what they put down, the market gave them something too. So to your point, a lot of these people have what we call trapped equity, right? So that's why you're not going to see. In 2008, which I went through, these people had no equity, right? They lost their down payments, which they understood, but there was no trapped equity from the markets. And so they bailed, right? And so imagine this, guys. 0 down, no equity.
Right.
Like, what's your downside?
Yeah. Why wouldn't you walk away?
Obviously you have some issues that could hit your credit, but now it's to Danille's point, 10%, 20% down, plus they've got some imputed equity there.
Yeah, and it's really hard to get a loan. So these people also generally have pretty good credit too.
That's the other point. So one of the things, that's why I brought up your example. What we were saying was, yes, the prices where she wants to buy are also up, just like where she wants to sell. Mm-hmm. So when you're trading laterally. You're just trading for a different kind of a product. So here's what everybody wants. Everybody wants to sell at the peak and buy at the low point, right? Mm-hmm. But you can't do that at the same time in a market, right?
Right.
So unless you go somewhere else, which you could definitely do, you can go to another market and maybe have that. But most of the time, you're just going to move laterally. You're going to move out of one house to another house, let's say. Let's say they're the same price. Well, if they are the same price, you're going to be paying a lot more per month because the mortgage payment's a lot more, right? So that's why a lot of people are just going to stay put. But as you start to move your money around, the thing to look at is the thing that Danille and I were just looking at, which is how much more in rent can she get for a different product type. So you got to look at your imputed equity. So we just did this on our whole company in a 5-property recap, and I'll do some videos on this later. We took 5 properties. We took a look at the equity that we had in all of them, and then we looked at the return. We didn't look at our past returns. We just looked at how much cash flow based on the imputed equity today. And then that's what Danille's doing right now on our condo. How much cash flow based on her imputed equity today? Don't look at yesterday. Just look at today. So if she's got $150,000 or $200,000 of equity, because I think you have quite a bit in this property. Actually, you have it paid off, right? Mm-hmm. Is that the one? So she's got over $300,000 in equity just sitting in this property with a little bit of cash flow, let's say, right? So you have to take a look at that. What are you going to do with that? Do you move it? Do you 1031 it?
Right. And so something else that you kind of look for, so let's start with the impacts if there were to be like a crash, like things you're looking for. Because I know a lot of you out there, they still don't believe us. And we can say it, and you're still like, yeah, but there's going to be a crash. So falling home values, right? Obviously, that is one. But I challenge you, because I'm assuming you're working with a realtor, and if not, you should be. Instead of, when you're looking at a neighborhood, instead of looking at all the listings, ask your realtor how much things have sold for in the past year.
That's it.
Not how much they've been listed for, but how much they've sold for, because that's the true data. So,
okay, guys, I'm just going to, the house that we just bought, mm-hmm. The guy listed the house $4 million higher than we paid.
Right.
$4 million, right?
Right.
So in 260 days, he dropped it $4 million.
Right. So he dropped it a third of the price.
Oh, it was incredible, right? So all right. So now, was it wrong for him to list it really high? No. But we just waited. But if
you would have seen that, you would have said, oh my gosh, this dropped 33%.
Correct. Right. So what's the real true value of the house? What it sold for.
Right.
And that's what Danille's trying to say is and the reason it didn't sell was because if you would have taken a look at what this market has sold, what the pricing had sold for, then he shouldn't have priced it that high. But he had convinced some realtors to do that because they wanted the listings, and of course he fired like 3 or 4 of them.
Yeah, he's on his fifth row. But so you need to look at that. So if you're looking at a community, you really should know this no matter what. What have things sold for? Because you don't want to overpay. So what have things sold for in the past 6 months or past year?
That's the only thing.
And those
important.
are your comps, because I could list a house for whatever, and I could find a realtor to list it for whatever I want. So you need to look at that.
So like with Danille's condos, the average condo sold that's like hers was in the 330s, right?
Yeah, 330s in the last year.
But there's nothing listed.
There's nothing. Everything's listed from 360 to 404. They're all the same size. They're all the same updates.
And they're sitting there on the market. So they're 50, 60,000 more than they sold for a year ago. And this is why the days on market is close to 6 months.
It is. And it's also why you could look at that if they end up dropping it to 330 and say, oh my God, that was a 20% reduction. And
then then all you guys are going to go, oh, look, the market's dropping, where it's literally the only thing that's happened is it's flat, or it's just settling back. It's not increasing like it was. It's a very different. If something is artificially listed high and then dropped, it doesn't necessarily mean that the market's crashing.
Right. You just have to look at when it's sold. So something else that happens, an impact if there were to be a crash, and this is important, is lenders tighten guidelines, which makes it harder for people to get loans. So I don't always think people really consider this. So if you're sitting on the sidelines and you're waiting for a crash and you're waiting for all this turmoil, will you still be qualified for the amount of loan that you want to get? Because they're going to tighten the guidelines. They always do. They did it in 2008.
Yeah, and that's actually what I think we need to start watching is that, right? And the mortgage industry got a real black eye, obviously, in the past, and so you're going to start to see that it's going to be they're not going to start doing the crazy the low downs and except we are seeing that with the builders. So the builders are sitting on inventory and they're buying down these rates for a year or two. And the thing to watch is going to be that, because what they're doing is they're getting these people into new homes. And this is another point I guess we should bring up. New home building is actually doing fairly well. And so the builders, mostly these big national builders, can basically manipulate the mortgage just like a car dealer does, right? Where they spread it out over longer periods of time, or they buy down the rates or whatever. They're basically fitting the mortgage to what you can afford. They start there and then they work backwards. If you own in a neighborhood right next to that, you're going to have a massive disadvantage because you're not going to be able to do that. And so to Danille's point, the mortgage companies are not going to do that. They're just not. Right. So I don't think that's another really good point, even though delinquencies are up a little bit. Like we're at a 13-year high.
Well, they are, but let's look at foreclosures, Sherry. Clip 2. So if we go back to the foreclosure rate here, foreclosures haven't been this low since 2006. So essentially, now those of you could say, oh my God, but look what happened in 2008. But it's not necessarily a pattern. I'm just saying they're low, and you need for foreclosures to start going up, meaning people aren't making their monthly payments, right?
But let's talk about the difference between the two, because I think this is an important point. There's delinquency, which means you can't pay something, and then there's foreclosure. So, but you can't compare this with 2008 because there was no equity. So you can be delinquent on something and not make a payment, but you still might have $50,000 or $100,000 of equity in a home.
Right.
That's the difference.
That is right. Correct.
So if you still have $50,000 or $100,000 of equity in a home, and you can't pay your payment, the lender is probably going to work with you, right? Or, it's different than 2008 where both were gone, right?
Or you're just going to sell your house. I mean, if you can't make your payment, correct. You have $50,000 in equity, you're not going to just say, I'm just going to wait till this thing forecloses. You're going to want to get your equity out.
I'm just saying that, equity, the amount of equity that people are sitting on has never been this high, which is good for a lot of people. But it's not. You can't compare that with 2008 when you're talking about foreclosures, because in foreclosures, if you had no equity, they called it jingle mail. You just toss your keys to the bank and walk away. In this particular case, you're walking away from equity. It's a big difference.
Yeah. So let's talk about if prices were to go down lower than you bought it, because I think that's a big buyer fear, right? I'm going to buy this house for $500,000, and then it's going to go down to $420,000. So let's talk about that, because I think that freaks people out. So,
well, if you're buying a car, you don't care.
I know, but so the number one thing's obvious, right? You have negative equity, right? And so the house isn't worth as much.
Maybe.
And you're kind of bitter because you feel like, oh, if I would have just waited 3 years, I could have got the same house for, $80,000 less.
Yeah, but there's a bunch of other factors here. The first thing is if you're buying a home to move into, then like I was in my house for 17 years, right? I built the house, and after I built it, the market crashed. 2008, like I could not have built it at a worse time, right? And it was down for, I don't know, 4 or 5 years or whatever. I raised my family there. I love it. I still haven't sold it, actually. I still own it. You know, and it went down, and then it slowly went back up, and now it's like, millions more than I built it for, but it was a long, long road, right? So the point is what are you going to use it for? If you're trying to time the market and trying to sell something, buy low, sell high, then I get it. But if you're just trying to make it cash flow,
or just living
let me give you an example. Like if you could sell your one of your houses, if you bought one of those houses and the rent was $3,000 and you were cash flowing like crazy, and the price went down another $40,000, $50,000, $60,000, would you care if your rent was still $3,000?
Right.
You don't care, because you're solving the cash flow in that particular case, and hopefully you have a fixed rate mortgage. So it doesn't matter really. It depends on your exit. So if you have a maturing loan or you're trying to time the market, then I completely understand this philosophy. Now, nobody wants to buy something and have it go down too. Psychologically, that rattles people, right? But they do it with cars every day.
But also, if you're going to stay in it, it's going to go back up over time. So,
this is my point.
Right. If it's a short-term play, I don't even know if buying a house is for you, because I don't think you should just guess and hope that it's going to go up. Like, I don't think it should be used to stay in it for 5 years and make money, because you may or you may not, right? But I do think if you plan on the long haul, raising a family, doing all that yes, I mean, it's going to go down and up in the time that you own it.
Here's if you're in an apartment or a small condo, let's say you have kids and dogs, and and there's 2 of you, and you're managing, you're working your butts off, and we're talking about a lifestyle issue here, right? Go bite the bullet, go buy a house. Take care of your family and go get comfortable, if you're going to work that hard. And don't worry if it goes down just a small percentage, even if it does. It may or may not. But today you're going to have, mortgage rates high as well. And then what you can do is, over time, just like all of us, the market tends to trend up. Just look at history. If you're in it for a while, and then if rates go down, if they do, you can hedge that too. So you get a lower payment, and you have more equity, and now you've moved yourself into a better lifestyle.
So let's talk about other things than just the negative price, because there is impacts of the negative price, right? So this is important for a lot of you too, is that you can't refinance, right? If the price goes down and you don't have enough equity in the deal, then you can't refinance. So you might be stuck with that higher rate. And that's why I don't necessarily like it when realtors say, marry the house, date the rate, because you're sure rates will eventually go down, but can you refinance? And that's what happened to a lot of people in 2008. They kept refinancing out of those loans, but then all of a sudden they couldn't anymore because the house was worth less than they owed on it.
But they already pulled all their money out. That was the thing.
Right. I'm just saying, this is a thing though. Somebody pays $500,000 for a house. It goes down to $420,000. Rates go down. They want to refinance because they kind of took on a payment that was a little more than they could swing. And now they can't because they don't have enough equity to. So that's that is something that you have to be aware of if you're a buyer, that could happen. If the market were to go down, that is one of your risks.
It's definitely a possibility.
Yeah.
Right. But the one thing that if the rates do go down, the one thing is the bank is going to look at your income, and they're going to look at your mortgage payment, which will be less. Maybe you can stretch a bit, right? So the point is that the bank is solving to, yes, they're going to do an appraisal, all that, but they're also solving to your payment.
Yeah, they are.
Right?
Yep.
And so, that's another piece of the refinance process.
Absolutely. And then something else that's a risk to you as the buyer, if the market were to go down, and you need to move, you're going to have a hard time selling because you're going to have to make up the difference in the mortgage, right? So if your home's now worth you bought it for 500, you can only sell it for 420, you're going to have to come up with the 80 grand to sell it.
Unless you put that as a down payment.
Correct.
Right.
Right.
Which you may have. And,
right.
and so there might be cash at close. That's for sure. It could happen. But I'm a betting man. I'm telling you, it's not going to happen.
Right. And then obviously you have a foreclosure risk, if you can't afford your payments and everything else. But I do feel like people in this kind of market are so much, if you think about 2007, 2008, we didn't have the internet. We didn't have all these rental sites. Like people are I know people that are running out their guest houses, their spare bedrooms. Like if you really couldn't make your mortgage payment, I think a lot of people are going to get scrappy before they just walk away from their house.
That's why I think foreclosures are down, even though the delinquents are ticking up a bit. That is for sure. And I don't know where rates are going to go. I do think they're going to go down a little bit, but I don't think we're going to see these crazy low rates before because guess what? That's what created the bubble.
Right.
But the one thing that we need is it's a double-edged sword. We need low rates to build, and we need low rates to refinance, and we need low rates to buy, but they also drive prices up.
Right. All of those things.
Right. So, that's the thing. You got to, and so the fact that there's not a lot of new construction coming in the future, it's just going to create an affordability problem. So Trump's going to have a massive affordability problem in about 2028. You're going to see this all over the place.
Yeah, and also, you have to think about that too, because a lot of the buyers are waiting for lower rates too. But with lower rates, a lot of times come higher prices because people are always solving to their monthly payment, and you are too, which is why you're wanting lower rates. So you just have to you have to weigh it all in when you're deciding whether or not you want to buy. But I wouldn't just be sitting on the sidelines just waiting for this 2008 scenario to happen. And like I said, the biggest thing to take away from the video is look at the data. Don't just look at all this clickbait stuff because it's all over the place. It's all over the internet. The news organizations do it too now, like Yahoo Real Estate does it. They put these leading headlines up to make you click. And, it's not necessarily accurate. And I just think a lot of people are making financial decisions based on that.
Right. I agree.
Yeah. Well, you guys need to check out our podcast. We are on every Thursday. We deep dive into MC companies, which is Ken's company, and also kind of into our own personal investments. So
we got a huge new deal I'll tell you guys about on our podcast. It's very, very exciting. The first thing we're doing is we have an access agreement, so we're actually walking the property now, and then we're putting it in escrow officially this week, and we're going to close it in a couple months. So another one will be close to a little over $300 million that we'll have done in Q1. So very exciting first quarter for us.
Awesome. Well, we'll see you guys next week.
Cheers, guys.